Welcome to today's discussion. We're diving into the world of income ETFs, specifically focusing on a fascinating aspect often misunderstood by investors, return of capital, or ROC. It's a topic that can seem complex, but understanding it is key to making informed investment decisions.
Absolutely. Many investors are drawn to the promise of consistent income from ETFs, but the mechanics behind those distributions aren't always transparent. ROC plays a significant role, and it's crucial to understand how it impacts both your returns and your tax liability.
Exactly. Many assume that all ETF distributions are simply dividends or capital gains, but ROC throws a bit of a curveball.
Precisely. It's a return of a portion of your original investment, not actual income generated by the fund. This can be confusing, especially when you see a high yield.
So let's unpack this. What exactly is return of capital, and why do income ETFs use it? Let's start with the basics. Can you define return of capital for our listeners?
Return of capital, ROC, occurs when an ETF distributes more than it earns in income or realized capital gains. This is often necessary for income ETFs that aim for frequent distributions like monthly or quarterly payouts. Remember, options premiums, a common source of income for some ETFs, don't count as investment income for tax purposes.
So it's essentially a return of part of the investor's initial investment.
Exactly. It's not new money generated by the fund's investments. It's a portion of your original principal being returned to you. This is important because it affects your cost basis.
And how does that affect the investor's cost basis?
ROC reduces your cost basis. This means that when you eventually sell your shares, your capital gains will be lower, potentially deferring tax liabilities. However, it's crucial to remember that consistent ROC without sufficient overall returns can erode your investment's value over time.
So why do income ETFs rely on ROC? It seems like a bit of a workaround.
It's a tool to achieve a specific goal, consistent distributions, markets fluctuate, and income from dividends and capital gains isn't always predictable. ROC helps smooth out those fluctuations, providing a more stable income stream for investors.
So it's about creating the appearance of a higher yield?
Not necessarily creating a false appearance, but rather meeting investor expectations for a consistent yield. Investors are often attracted to high-yielding ETFs, and ROC allows funds to maintain those yields even when underlying income is lower. It's a way to manage investor expectations and maintain a steady distribution schedule.
That makes sense. It's a balancing act between providing consistent income and the actual performance of the underlying assets. Let's talk about SEC regulations. How do rules like 19b1 impact the use of ROC?
Rule 19b1 limits how often ETFs can distribute long-term capital gains, typically to no more than twice a year. This prevents funds from artificially inflating their yield by overdistributing gains. ROC helps bridge the gap, allowing for more frequent distributions without violating this rule.
And what about the 19A1 forms? What information do they provide?
19A1 forms provide investors with estimates of how distributions are categorized, income, capital gains, or ROC. It's important to remember that these are estimates, not final tax documents. The final breakdown comes with your Form 1099 DIV at the end of the year.
So investors shouldn't rely on the 19A1 forms for tax purposes?
Correct. They're helpful for understanding the general composition of distributions, but the final figures are subject to change. The year-end 1099 DIV is the definitive document for tax reporting.
You mentioned market fluctuations. How does that uncertainty affect the categorization of distributions?
Market uncertainty makes it nearly impossible to accurately categorize distributions in advance. The actual composition of income, capital gains, and ROC can only be definitively determined at the end of the fiscal year after all transactions are settled.
So the mid-year estimates are just best guesses?
Essentially, yes. They provide a general idea, but the final categorization depends on year-end reconciliations. This is why it's crucial to understand that the 19A1 forms are just preliminary information.
So what's the key takeaway for investors regarding ROC?
Understanding ROC, Rule 19b1 and 19a1 forms is crucial for making informed investment decisions. Don't let the complexity scare you away. It's about understanding how these mechanisms work together to deliver consistent income while maintaining transparency.
And it's important to remember that ROC doesn't necessarily mean the fund is losing value.
Absolutely. A fund can distribute ROC while still generating positive total returns. The key is to look at the overall performance of the fund, not just the distribution amounts.
Are there any other important points investors should keep in mind when considering income ETFs and ROC?
Yes, it's vital to carefully review the fund's prospectus and fact sheet to understand its investment strategy and how it manages distributions. Pay close attention to the expense ratio and the fund's overall performance history. Don't solely focus on the yield, consider the total return.
So it's about a holistic view of the investment, not just the distribution amount?
Precisely. Consider the fund's overall investment strategy, its expense ratio, and its long-term performance. A high yield isn't always indicative of a good investment.
Just let's briefly touch on the tax implications again. How does ROC affect an investor's tax liability?
ROC is not taxed immediately. Instead, it reduces your cost basis, potentially deferring taxes until you sell your shares. However, it's important to consult with a tax professional for personalized advice, as tax laws can be complex and vary depending on individual circumstances.
So it's not a tax avoidance strategy, but rather a tax deferral strategy?
Exactly. It defers the tax liability, not eliminates it. The tax will be due eventually when you sell the shares.
Let's illustrate this with a simple example. Imagine an income ETF that distributes 10% annually. Half of that is ROC. How would that impact an investor?
In this scenario, the investor receives a 10% distribution, but only half of it is considered taxable income. The other half reduces their cost basis. This means their capital gains will be lower when they eventually sell their shares. However, it's crucial to remember that the fund must still generate sufficient returns to offset the ROC distributions to avoid a net loss of principal.
So it's a complex interplay between income, capital gains, and the return of the initial investment. Where can investors go to learn more about this topic and find reliable information?
The SEC website is an excellent resource for understanding regulations like Rule 19b1. Individual fund prospectuses and fact sheets provide detailed information on distribution policies. Consulting with a financial advisor can also provide personalized guidance.
And it's always advisable to seek professional financial advice before making any investment decisions. Let's address a common misconception. Some investors might think that ROC is a bad thing. Is that accurate?
Not necessarily. ROC can be a useful tool for income ETFs to provide consistent distributions, especially during periods of lower income or gains. However, it's crucial to understand that it's a return of your initial investment, not new income generated by the fund. The overall performance of the fund is what matters most.
So it's not inherently good or bad, but rather a tool that needs to be understood within the context of the fund's overall performance?
Precisely. It's a tool that can be used effectively, but only when understood correctly.
Before we wrap up, any final thoughts or advice for our listeners?
Remember, understanding ROC is crucial for making informed investment decisions. Don't be intimidated by the complexity. Do your research, read the fund's prospectus, and consider consulting with a financial advisor if needed. Focus on the overall performance of the fund, not just the distribution amounts.
That was a great discussion. Thank you for sharing your expertise and clarifying this often misunderstood aspect of income ETFs.